Hi, it's Arjun. We continue our series of long takes on the macro mess that we are currently slogging through, and wanted to hit upon a couple observations from what's really been a surprisingly interesting earnings season, where some of the takeaways we think are relevant to both corporates and investors as they think through long-term opportunities and how to position. There are three topics that we wanted to hit upon today. And the first comes courtesy of Diamondback Energy and their frankly must read letter to shareholders, which is the question of, is US shale oil peaking? And if it is, what does that mean for the energy macro? The second big theme comes from Next Era Energy in their call, where they made some really interesting remarks about the relative economics of various energy generation sources and how they can all be used to meet what they see as substantial US power demand needs. And then the question is, when you think about these first 2 points, maturing shale and this issue of meeting power generation growth, what does that mean for both companies and investors, and how to think through positioning, activity, structural changes, and so forth for the decade ahead, especially for investors? What do you want to own? I think for companies, how might you want to or need to reposition yourself in light of some of these key themes? So the first topic I want to dive into is this question of peak US shale oil. And let me just say that we are big fans of the letter to shareholders that Diamondback writes each quarter. This one was particularly good, but I do think this is the best practice that I'd love for more companies to do. You see it in other sectors versus the typical sort of media and legal press releases we get. I appreciate this idea of writing to your shareholders. And the one published May 5th, I think, was especially interesting in that both Travis and Kay spent a bunch of time reflecting on the evolution of shale. I'm going to sort of paraphrase, I'm going to read from this a little bit here, but the shale revolution has evolved from proof of concept, where you outspend cash flow to prove up basins, to manufacturing mode and significant growth, to now a more mature stage of development where free cash flow and returns of capital are the priorities. Today, geologic headwinds outweigh the tailwinds provided by the improvements of technology and operational and efficiency. And let me just pause there. That is a remarkable comments coming from what is one of the most successful and leading shale oil producers. Diamondback, of course, is a pure play Permian producer and really one of the best performing E&Ps out there. And these comments, frankly, are not wholly different from what we heard from former Pioneer Natural Resources CEO Scott Sheffield during CERAWeek, where he noted that, I think it was in a TV interview, that he had sold his company to ExxonMobil in part out of the recognition that ultimately Pioneer was going to run through its tier one inventory and would have to diversify. And frankly, the implications, and I'm going to give Diamondback a lot of credit for being as clear and as blunt about how they see where shale is in its life cycle. It's been a debate amongst investors, amongst corporates. When is shale going to peak? How much running room is there? Is it starting to mature or not? You can't be any clearer than Diamondback was in their letter. And frankly, the implications of US shale finally maturing they're profound for commodity prices, for geopolitics, for corporate strategy, and for industry M&A. And all of these points, frankly, are worthy of their own in-depth video or written follow-up in their own right. But let me just sort of briefly summarize a few initial takeaways and thoughts that we have. First, it really is just a matter of time before the near-term oil market weakness gives way to much healthier long-term fundamentals. And just as a reminder, over the last decade, US shale oil has essentially been all or the vast bulk of net oil supply growth. It's not a close call. Yes, Canada and Iraq and UAE and Russia has grown a little bit, but it has been swamped by US shale oil, not just in size, but also kind of its ease and its ability to grow at, let's just call it, a sub 80 and even sub $70 type oil price. This has been a huge limiter, shale oil growth, to oil prices not already being much higher. And now you're hearing from the leading current Permian E&P pure play Diamondback, and we heard from the previous leading company Pioneer, that there are limits to the geology here, and we may be bumping up against it. It is very meaningful. I think the second point we want to make is it reinforces our view that OPEC's decision, it started in March, but then ramped up in April and May to dramatically or more quickly than expected return previously withheld barrels to the market. We've been calling it pump for Trump. I just really don't know what other conclusion you would draw to. I think OPEC is certainly well aware of shale dynamics. They spend a lot of time studying it. I think they are cognizant of the fact that, yes, a decade ago, the expectation was shale was going to mature and not withstand the move from 100 to $60 oil, and it did, and actually turned out to be stronger than ever. But we're now 10 years progressed. I think OPEC understands that. The idea that OPEC is mad at Kazakhstan for finally bringing on the Tengiz expansion project, which, by the way, is led by a U.S. company. The number two partner is also another U.S. company. This is Chevron and Exxon, of course. The idea that they're sort of mad at that, so they're now going to unleash oil on the market to teach Kazakhstan a lesson, I find honestly preposterous. I've been calling this pump for Trump. I don't know what else you'd conclude, especially when the April extra increase, if you will, was announced on Liberation Day itself. And so the Trump administration, of course, has been calling for lower oil prices as a way to tame inflation. And low oil prices we generally think of as being in the 50s. We'll see if that's how things turn out. But I think our view is that what you're doing right now is you might be transitioning OPEC spare capacity, which is generally more limited, though it's going to hurt in the near term. It's generally more limited than most people think, in exchange for what had been very low above ground inventory, storage tanks, and terminals. Once that oil is unleashed, it is a clearing event, right? So you have shale maturing, and you've got OPEC kind of bringing back on their spare capacity. It's going to hurt for some period of time here. We're not saying it's not. I'm going to call it pump for Trump. And I'm going to say this sets us up pretty well for the long term in this business. Now, most companies, this is our third point, most companies, especially those that kind of went all in on shale as the be all and end all, there is a big question of what comes next. And we alluded to this last week in our shareholder activism video podcast, where we said there are kind of three good outcomes for companies. One is that you are a going concern, which ultimately means for the vast bulk of companies, you're going to need to diversify. The second good outcome is you sell yourselves. I think some people will take that option. We've already seen that. And the third option, which actually I think some of the better positioned, higher quality companies could consider, is becoming a yield vehicle and basically returning the bulk of excess cash back to investors. That is, I think, a viable plan for the shale business long term. And all of those are preferable to being a cycle rider or ultimately turning into the living dead, as we noted the bad outcomes. But this concept of if you're going to be a going concern, you're going to need to diversify. I think that Diamondback letter that alludes to geologic maturity and shale growing here is really going to be a big catalyst to activity going forward, to a change in industry M&A activity going forward. I think just the final point we'd make is, and we want to be clear, the idea that shale is in a peaking process does not mean it's necessarily going to go into some rapid and quick decline. In the short term, if you cut drilling activity, you do see a negative production response, usually pretty quickly. But we do think substantial shale production can be maintained for quite a number of years. So it's not about shale going away. But again, I'm going to use sort of Saudi as the example, that Saudi's relevance to oil markets, it's not just that it's big. It's always been the idea that it has had spare capacity that can be brought onto the market. So for the US, from a geopolitical perspective, it is important not just that we're a large producer, but that we do have avenues of, I'm just going to call it, quote, spare capacity or ability to grow. And if that's going to be increasingly not so much in shale, that then speaks to the importance of the deep water, the Gulf of Mexico. It speaks to Alaska. By the way, it even speaks to California. We need to have, in my view, an all of the above mindset to our oil resources. And it also speaks to the strategic relevance of our closest neighbor and historically our closest ally, Canada. You all know I'm a huge fan of the Canadian oil and gas industry. I appreciate the substantial resources. I appreciate the ability for the leading companies to be competitive on profitability and growth. And I think being closely aligned with Canada is important geopolitically for this country. They are our friend, and we need to ensure whatever disagreements we are having right now, we work through them and we become closely aligned. I think for companies, we continue to believe Canada is a very interesting oil province, natural gas and LNG province. And as shale matures, I think the relevance of Canada specifically is only going to grow. The second main area we want to highlight today is courtesy of NextEra Energy. And on their call, we thought CEO John Ketchum made some really interesting points. They estimated that the US will have 450 gigawatts of total power generation needed by 2030. I believe that was growth in power generation. Of that, they expect natural gas to account for about 75 gigawatts of the growth to come online by 2030. But they also noted that natural gas is higher cost than renewables plus storage, especially in an environment where gas turbines are in short supply and in high demand. And there are also some skilled labor and other challenges that raise the cost of building gas-fired combined cycle plants. I'm going to pull up the graph here. This is their graph of levelized cost of generation capacity. It's in dollars per kilowatt month. And you can see a 4-hour battery storage is $8 to $12 on this metric versus a gas peaker, 2 gas peaker metrics. And so, yes, you might have to string together a few of these 4-hour battery storage metrics. But let me just go through what we think are some of the key points and conclusions here. The first is, and I thought the CEO of NextEra really articulated it very well, is we truly do need all of the above power generation. We don't need a left to center administration talking about the climate crisis and only arguing for renewables and storage as the be all and end all. And by the same token, we don't need the right of center administrations declaring that renewables are dumb, that they're intermittent resources, and that thermal is the be all and end all. We don't need either extreme. It comes from Democrat and Republican administrations, and it comes from the activists on both sides, the climate activists on the left and those on the far right as well, that have turned energy sources bizarrely into partisan issues. There is no chance energy sources should be partisan in nature. It's ridiculous. All these generation sources, whether it is solar, wind, batteries, coal, natural gas, nuclear, what have you, they all have pros and cons. They all have slightly different characteristics in terms of how quickly they can be brought online, the manner in which you run them. For example, you can have solar panels on your house. You can't have a nuclear plant on your house, or for that matter, a natural gas plant. There is a dispatchable nature of things like natural gas, which is good. There's a dependability to nuclear, which is good. Renewables plus storage are increasingly a very competitive form of power generation. All of these characteristics are why, in general, to have a healthy grid, you look at countries, you look at regions, usually diversification of energy source is key to that. And I think we're finding that out in a number of areas. All anyone cares about is reliability. That's all a regular person or a business cares about. How do you get reliability? Diversity of generation source. They next care about affordability. You'll always take it being on versus what you pay for it. What you next care about is affordability. So how do you add up these different generation sources to get to not just reliability, but also affordability? And we will acknowledge when it comes to topics like geopolitical security, as well as environmental considerations, that is where the policy element can make a difference. We've used the example that if you're a country like India and you are not blessed with a lot of oil or natural gas, you are going to absolutely do solar plus storage, and you're probably going to develop coal as well. So there's a role for coal here. If you're a developed, mature economy, it's about not prematurely retiring coal plants, which are critical, can be critical to ensuring a reliable grid, which is absolutely the number one thing that anyone should ever care about. And of course, if you're a developing economy, you're going to be growing your coal pretty substantially. But the idea that we only need things like coal or natural gas is also not true. Let these energy sources compete on the economics. I thought the CEO of NextEra said it well. We're not trying to pick winners. Let energy sources compete, and you will get what everyone cares about. These are now my words. You will get reliability and affordability, and with some policy, we will make sure that geopolitics and the environment are taken care of as well. So I just want to tie in this final little bit here these two themes together, sort of the maturing of shale, and I'm going to call it all of the above power generation. I think we'll make 4 points here. I think the first is that over the coming decade, we expect growth in power generation to meaningfully outpace oil demand. which is oil demand is facing kind of a lot of noise and maturity in China, as well as other macroeconomic headwinds. And like power is, of course, not immune from economic concerns. But when you build in and think about digital transformation, artificial intelligence, general electrification themes, the challenges of an aging infrastructure and grid in developed markets, and the need for just basic economic growth driven power demand in the emerging markets, all of that speaks to a pretty favorable outlook for power, frankly, over the next decade, more so than oil. We are not believers in peak oil demand, but that's not the same thing as saying it's just going to grow gangbusters either. I think the second point we would make, though, is that in the oil business, you absolutely can have a very good mid-teens return on capital type business. And I think in an environment where shale oil is maturing and demand is otherwise not going away, even if it's not growing at gangbuster rates, I think companies that are positioned, that are ahead of the curve in diversifying or recognizing that maturity, they can actually have a pretty good business. And I do think we're setting up for a world where when you don't have US shale oil easily ramping up, when OPEC does sort of bring back on their spare capacity, I do think you're actually heading towards a healthier oil environment, probably in a couple of years type time frame. I think the third area is that when it relates to natural gas, we are expecting significant growth ahead, make no mistake. But natural gas has always had to compete with alternative energy sources. And so to me, the lesson to take from that is that with natural gas, it's not about trying to bet on some super cycle for either Henry Hub natural gas prices or LNG prices or what have you. It's about ensuring you are at the low end of the cost curve and that the natural gas you're bringing to market will ultimately result in competitive economics for end users versus the alternatives. And renewables, we're going to say mostly solar and batteries, but it could be wind as well. They're going to be stiff competition for natural gas around the world, and no one should be under any illusions about that. I think the final point we'd simply make is we are going to see massive growth in renewables. So, my background is more on the traditional energy side, but I've come to appreciate that, especially solar, to some degree wind with batteries, we're going to see a lot of growth. The question still is, how do you want to play that? We've seen things like the ICLN, the Clean Energy ETF, or the TAN, which is the solar ETF. They've done extremely poorly. That has not been the way to play some of these power generation themes. On the other hand, the IPPs, other companies that are involved in power infrastructure, companies that are in the business of producing gas turbines, those stocks have so far done much better. So the power generation theme is complex. We've got a quartet of oil service companies trying to transition or at least add to their traditional frac businesses in distributed generation. I think there are going to be lots of really interesting opportunities to change and transform your business. And I think investors and companies have to sort through what does present the most favorable risk reward. It's not necessarily just the headline, okay, solar is going to do well, so let me buy the solar ETF. So I would like to end this video on a personal note. And I mentioned Diamondback's great letter to shareholders. I have a good history of, I don't do the live conference calls anymore, but I never once congratulated a company for having, quote, a good quarter. No one should do that, by the way. But when there is management change and retirements, I think those are the things that have stood out to me that are worthy of mention. So first of all, congratulations to Travis Stice for he's going to be retiring as CEO, I believe, consistent with their annual meeting. I think he's going to stay on as chairman. And congratulations to Kees Van Hoff for taking over that CEO role. And, Diamondback Energy, they started, I believe it was a $500 million valuation when they went public in 2012. That is 12, 13 years ago. They are now a $30, $40 billion market cap company. It is remarkable value accretion. So congratulations to Diamondback. And I hope they won't mind me sharing a somewhat recent, it's about 4 years ago, personal story that ultimately led me to Veriton. But they had been, Travis and Kees had subscribed to Super Spike from the beginning. I appreciate their readership and their viewership. And they invited me to just present some of those thoughts to their board and management team. I want to say this was 2021. Maybe it was early 2022. It was that experience that led me to believe, hey, that was a lot of fun. I think I want to do this for a living. So I was a senior advisor. I was on the advisory board at Veriton. It was that meeting with their board that motivated me to, quote, unretire. And now I am saying this, I am employed full-time None of this unretirement talk. We were actually working full time. I'm a partner at Veriton. I love it. And it really, the catalyst was that meeting with Diamondback. So congratulations to the whole Diamondback team. Congratulations to Travis and Case. And thank you. Thank you. I love being at Veriton now. And it was your meeting that got me to get back into full-time work. Thank you.